Hey guys, in this short video I'm going to compare some of the different qualities of fiscal and monetary policy. We're going to talk about how they work a little differently and some of their pros and cons and maybe an idea for how best to choose when to use what. So, it's going to be pretty short, but let's get started. Let's start with talking about expansionary fiscal policy. We can reverse all the following arguments for contractionary policy. I'm not going to bother in this video. But we have two main choices. We can lower taxes. And how does this expand the economy? Well, lowering taxes increases disposable income. Disposable income is income minus taxes. Smaller taxes is more money to spend. That means that there will be more consumption and more investment in the economy. That's an increase in aggregate demand, which means we're going to see more GDP, higher price level, and less unemployment. Now, our other option is we can increase government spending. And this is more direct. It just increases aggregate demand directly. And that will have the same end effect of raising GDP, raising the price level, and decreasing unemployment. Might not have the exact quantity changes because of the multiplier effects, but you can check out my other video on that if you wish. Now, let's compare these pathways from policy to result with expansionary monetary policy, where we have four choices. What are the four things the Fed can do? One is it can buy a bunch of bonds, open market operations. Another is it can lower the reserve ratio. The next is that we can lower the discount rate, the rate at which the Fed loans to banks, and we can decrease the interest on reserves. Any of these, all four of them have the same expansionary effect. They all follow the same path, which is that they increase the money supply. They will encourage bank lending, basically, or inject money directly into the system. And that decreases interest rates. And that raises consumption and investment, which boosts aggregate demand, which increases GDP and the price level and lowers the unemployment rate. So yeah, there's the different channels by which our policies move aggregate demand. Any of those six policies on the left wall will have the same end result, at least qualitatively. Now, so I got some of the pros and cons to each then. Fiscal and monetary policy, pros and cons. Let's see, fiscal policy can have specific targets. When we change government spending, we can boost spending in specific industries or areas, or we can target specific populations. Same with taxes. We can target individual groups or firms or industries or whatever. We can also use our taxation to address externalities. Another thing about fiscal policy is it can be big. The CARES Act in 2020, the COVID-19 stimulus package, $2 trillion, all spent at once. Fiscal policy has the capacity to make big change all at once. Another pro is automatic stabilizers, a form of fiscal policy go into effect no matter what people are doing. Some cons for fiscal policy: a slow decision process. Not for the automatic stabilizers, but for the discretionary stuff, it can be very slow. Partly because it's often politically motivated. Fiscal policy, spending and taxes, that's run by politicians. And they usually have more than one motive and are not solely focused on stabilization policy. For instance, whether you're in a recession or an expansion, there will always be the temptation to do expansionary policy during an election year to have a booming economy and make everyone want to vote for you. So there's kind of a conflict of interest there for running good policy. Another con is deficits. Oftentimes, to enact fiscal policy, we're going to borrow money. Mix that with the politically motivated part, and sometimes we just borrow money even when we don't need to. Another risk is crowd out, where if the government borrows too much money, it can crowd out private investment. Another is rent seeking, where individual groups or firms or industries might lobby their leaders to try to get fiscal policy to work out especially good for them. For monetary policy, one of the big pros is it's fast and easy. Federal Reserve instead of being hundreds of politicians, the big deciders for the open market operations, for instance, are the Federal Open Market Committee, a much smaller group of economists. And they can come to a quicker decision, and they have an easy channel to do their policy, and they can change interest rates very quickly. It's less political. I would even go as far as saying it's not political. At least the central bank in the United States is generally quite independent of the political process, which is a good thing, because they can focus on the economy. They can control inflation. If they decide to weaken our currency by printing a lot, then that can boost our exports. So stuff like that. What are the main con for monetary policy is the liquidity trap. It is a practical limit on how effective monetary policy can be, because once interest rates go to zero, don't forget interest rates, that third box from the left, that is part of our channel by which we increase aggregate demand. If interest rates hit zero, we can't move aggregate demand any farther. Another thing is it affects the whole economy. When we change interest rates, like the federal funds rate, that's going to affect everything. So we can't do specific targeting the way we can with fiscal policy. There's also a risk of hyperinflation. Bad policy making by these people could make some really big problems for our economy. And the last is, right now the Federal Reserve's main deal is inflation targeting. And we can ask the question, is that enough? There's more discussion to be had there, but basically, if all we're focused on is targeting inflation, maybe we'll miss important things in the economy. So, next thing we could ask is, when should we do each kind? What's our chronological order for most fluctuations? I've got these different policies that can all move the aggregate demand curve, and they have different pros and cons. So when should we do each? Well, part of it's decided for us. Automatic stabilizers always go first. Why? Because they're automatic. No one has to make any decisions, they just happen. Then usually the Fed moves next with monetary policy. The Fed is fast, the policy is direct and straightforward, easy to implement, they usually go next. The part that's usually last, or a last resort, is discretionary fiscal policy. Passing a big stimulus package is usually the last thing we do, because it can be big enough or have specific targets that the Fed couldn't reach, stuff like that. But yeah, I hope this is a good enough overview. Thanks for watching, you guys. You are almost done with your class, and so I wish you luck. Happy econing.